Well, hey guys, welcome back to yet another episode of the Young Investors Podcast.
Here we are.
Maybe, I imagine it would probably sound a little bit different today for people that are listening in.
Yeah, it probably sounds hopefully way better.
Probably way better. Because we are in a podcasting studio because I am in Melbourne. And I'm here with my good friend Hamish Hodder, who I, of course, do this podcast with every single week. And we are recording a video to this podcast as well.
Yes,
so if you are someone that normally listens to our sweet voices on Spotify or Apple Podcasts or one of the other wherever you get it, maybe go over to the YouTube version of the podcast this week and you can look at our pretty faces as well.
I tell you what, I'm glad that you remembered to say that because I would not have remembered to remind people to go over to the YouTube version and watch the video version.
Right, yeah. Well, I remembered. And fingers crossed this is all working well. Bit of a different system, but it looks like all of our audio is good. And I'm going to lump you with the task of editing all this together later on.
So, as always. It's always me. Why is it me, guys?
Well, I tell you why it's always you. It's always you because I'm coming down to Melbourne.
Yeah,
you need to come to Canberra and then I'll be the one editing it.
Yeah, which one's more effort? The few hours of editing or the 12-hour drive?
It's 8-hour drive.
8 hours, really?
Yeah.
Wow.
Well, it's actually like 7 hours, but I had to charge along the way for a couple, like an hour or two. So.
What do you mean you had to charge?
Yeah, it's so weird. We need to charge what? Charge a Tesla.
You have a Tesla?
I have a Tesla, dude. Bro. I don't fill up my car. I charge my car. Oh, dear. All right, well, let's get stuck in it. What do we got to talk about today? There's actually not too much going on.
Yeah, we don't have too many news stories. We were sitting here for a little while looking for some things to talk about, but we've got a lot of questions to answer. So in terms of news stories, we have some news stories on NFTs. The US Fed had some news come out about that, and the NASDAQ was down big last night. I don't know if you took a look at your portfolio, but...
No?
Ouch. Not that I have really anything, just Facebook stock, I guess. It's the only NASDAQ, but yeah, ouch.
It took a bit of a beating.
Yeah.
We'll have to... I don't want to talk about that, but we'll have to, I guess.
Yeah, no, but we've got a lot of questions. I reached out on Facebook to see... not on Facebook, on YouTube, to see if anyone had any questions they wanted to ask us or topics they wanted us to discuss. So we've got a lot of questions to go through. So we'll probably just use that as a bounce off to talk about some topics today.
Nice. All right. Well, let's get stuck into it. You want to do the sponsor?
Yeah, okay. So today's episode is sponsored by Sharesight, and Sharesight is an application that I've personally been using over the past few years in order to track the performance of my stock portfolio, and it's really good for keeping track of all of the different types of gains you experience as an investor. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you are buying shares internationally or you hold foreign currencies. And then the main reason why I use it, why is it, Brandon?
When it comes to tax time.
Correct. When it comes to tax time, you can use it to easily work out things such as your capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 4 months free when you sign up to a yearly subscription. I should have that memorized by now, but I don't.
Oh, it's close though. I reckon you're pretty good on it. It is funny watching you say that when we're live. You try to animate your face and get all excited about it. Oh dear, no, but we are very happy, of course, to have Sharesight on as a sponsor, because their platform is actually pretty damn useful. So thank you, Sharesight, as always.
Yeah, and if you are watching the video version of this, you can go just below and click the link.
Click the link in the description. All right, I feel way just more chill when we're actually in person. This podcast will probably sound so much different to our normal ones too, because I just feel it's so much easier because we're just like
so easy.
It's just talking to each other.
Yeah,
and we're always fighting that 1 second delay when we're doing it. Just looking at our computer screens, not even looking at each other. So it's actually I feel like it's gonna flow much better. We rarely interrupt each other when we're live. It's true.
very difficult to interrupt unless you just, I don't know, you're not looking.
Yeah, exactly right.
It's a very different thing online.
Yeah, absolutely. And it's so hard dealing with that 1 second delay because it's like you're caught in a space between, have they finished talking? Do I start talking?
Yeah.
It's like, oh, no, not yet. Oh, sorry, mate. Keep going. Yeah. Oops, sorry.
yeah, exactly right.
But anyway, what should we start talking about? Do you want to talk about NFTs? They
Sure.
have been taking the news, haven't they?
Yeah, what's going on with NFTs?
Well,
Tell me.
to tell you the truth, I don't really know.
Tell me, Brandon, expert of NFTs.
Expert, yeah. Well, I happen to own $69.2 million in NFT assets.
Wow. Really?
At one asset. No, we'll get to that in a second because that's the big news story. But so you might have been hearing this NFT acronym being thrown around recently. It stands for non-fungible token. And when I heard this come up and people started making videos about it, I was like, oh, that's some economics term. I've got that's something to do with the Fed or something like that. Yeah, it's just like someone's doing something with the cash rate.
Fugazi.
Yeah, Fugazi. It's a wazi, it's a woozy, it's a... Exactly right. But it turns out the NFT is quite related to the blockchain, and it's related to assets, as in like as not physical, digital assets, but this table's an asset, house is an asset, gold is an asset. Some would argue Bitcoin's an asset. So let me tell you about it. And to understand what a non-fungible token is, you have to break it down. So what does fungible mean? And by the way, I got this all from a YouTube video. So I am by no means an expert. I'm just basically relaying this information to you guys. So fungible means replaceable by another identical item. So it's mutually interchangeable. So things that are fungible include things like gold or cash or even Bitcoin. It's things that are kind of like a currency, I suppose.
Right.
So it's kind of like, if you had a $10 note and I gave you two $5 notes, I said, hey, can I have your 10 and I'll give you two $5s? You're like, oh yeah, it's fine.
Happily,
yeah. Because we know what the value is. It's the same. It's interchangeable, that sort of, that money.
Did you come up with that example yourself?
No, I got it off the YouTube video. So then we go to non-fungible. So non-fungible assets are assets with unique characteristics that make it different from something else in the same asset class. Also from that YouTube video that I'm completely copying right now.
Right.
So it's kind of like a painting. So if I had a painting and I said, I'll give you my painting, you give me your painting. You go, oh, well, the paintings aren't, there's something different about, I've got the Mona Lisa over here. You've got something you drew Photoshop in 2 minutes, So there's a characteristic about it that gives it some sort of value, which means one painting is different to the next kind of thing.
It's unique in some way.
It is unique in some way. Actually, one interesting thing is property. Property is another example of something that's non-fungible because while, you say, oh, I've got a house too, each property has its own set of unique characteristics, location, etc., which makes it different in value. Interesting. So, yeah, all these things are non-fungible items, but the artwork and the houses and what we're just talking about are physical items, obviously, exist in the real world. So what we're doing, these non-fungible tokens, is we're taking that idea of something that is non-fungible and applying it digitally. So people still talk a lot about, artwork is something that's coming up a lot. People selling artwork. And it's essentially that idea of something non-fungible but existing digitally. And you could say, well, hang on. Okay, if someone sells a painting online or someone sells a digital artwork online, I mean, what's to stop me from then looking that up on Google Images and taking a copy, printing it out, sticking it on my wall? And there's nothing stopping you from doing that. But in the same way, there's nothing stopping you from buying a print of The Last Supper and sticking it up on your wall kind of thing. So
there's only one person that has the original painting done by that artist.
Yeah.
And in the same way, I guess you could apply the same thing to digital art in that there's only one person who would have this particular token attached to the piece of artwork, but other people, of course, could copy it. So it's this bizarre thing that's happened recently where people are now able to sell, using the blockchain technology, they're able to sell legitimate original versions of their artwork. It's mainly being used for artwork. And they're able to do it digitally. So you can have this, I think you're going to talk about the example of Jack Dorsey, but you can have you can have some form of original artwork in a digital format, and you can be the one that has the original. Yes. And then everybody else has a copy. Right. So that's the way I understand it from the research that I did. Yeah. And the Jack Dorsey thing is where I probably not the first time I heard about NFTs, but one of the first times I was like, oh, this is kind of strange, and I started to actually look into it. So the Jack Dorsey thing, Jack Dorsey, of course, the CEO and founder, or still is he still the CEO?
Yeah, I think so. Of Twitter.
Yeah, of Twitter. Recently. And Square, yes. That's where I was getting a bit confused. Is he the CEO of both of those companies, or is he...
Jeez, I don't know.
I don't know.
Probably. Anyway,
not important to the story. He basically sold his first tweet as an NFT for $2.5 million. So
wow.
His first tweet was just setting up my Twitter, which is just great.
So he's made his version of the original of that tweet, and he sold the original of that tweet to somebody.
Correct.
And then we could go, okay, but we can scroll back through Jack Dorsey's Twitter and see that original tweet. But what we're looking at is a copy.
Yes.
Does that make is that right?
I guess so. And I mean, I guess I could take a photo of that and blow it up on my wall, but I wouldn't own that tweet.
You don't have that tweet. So there's someone out there that just wants to flex at a party that they go to when they're talking to someone at a bar and go, hey, you know that Jack Dorsey guy? I own his first tweet. Yeah, that's mine.
Honestly, if you had a ton of money, it would be very cool to have a huge blow up of the first ever tweet.
That's
the
great.
First ever tweet. And people will be like, wow, that's so cool. And you'll be like, you know what? I own that.
That's mine.
I didn't just download that off the internet.
It's mine, baby.
I own it.
That's hilarious. Oh, man. That's like the ultra flex. I mean, everybody, you'd be like, yeah, that's mine. And everyone would just be like, dude, I don't care. Good on you. No one cares.
Great. Good job.
Yeah. But this kind of talk about NFTs is leading us into an actual news story that I wanted to talk about.
Right.
I think we needed to go through that kind of baseline understanding first, probably for my own sake, to be perfectly honest. Where is it here? The news story on Thursday, okay, a digital collage of hundreds of weird, brightly colored images made by South Carolina artist known as Beeple sold at the prestigious Christie's auction for $69.3 million. The staggering price is the third highest ever for a work by a living artist, second only to pieces sold by art world giants Jeff Koons and David Hockney. So we have a record NFT buy and $69.3 million.
That is a lot of money. I have to go and see.
You have to look at it.
Like. Yeah.
It's literally a collage, as it says here. It's a collage of smaller images made by this. I think the image is made up of. It's a collage of Beeple's other artwork. I think he's just kind of stitched them all together. So how crazy is that? You've already made all this art and you just stitch it together as a collage and then you sell that. It's $69.3 million later.
Yeah, that's the insanity, right? Then you got to come back to the real world eventually and realize... What are you buying?
What are you buying? Yeah, exactly. $69.3 million.
Yeah. And I mean, I know people do appreciate, there is obviously a huge area of appreciation for art that I clearly have no idea. We were talking about earlier, in that article, it mentions two of the biggest artists or painters that are alive right now. And I have no idea who they are.
We didn't know.
Like, not even the number one. Like, if you think about, like, the amount of fields of different things, like sport and stuff, and the number one person in those fields, we probably know the number one in quite a lot of fields. Yeah. Like, the CEOs of the biggest companies and the number one sports.
Even, like, Brady or,
the greatest athlete
LeBron.
in each of those areas. But, art is one that I know nothing about. But, yeah, I mean, even I just cannot get around the idea of paying $70 million for a digital or physical piece of art. Yeah. Unless you just had a ton of money and you didn't know what to do with it.
It's so... I can't wrap my head around the idea of these artworks being digital artwork being collectible, just because it's that... I mean, it makes sense because like how we have the Mona Lisa and you make a print of the Mona Lisa and a lot of people own the print, but only one person owns the original, or it's in some museum, wherever it is. Is it in the Louvre?
Yes.
Yeah, right.
Hope it's still there.
I hope it's there. Call the police. But yeah, it's just still so hard for my mind to understand that this could be a thing that people are willing to because it's essentially like a collectible. That's the whole idea of the NFT, is to make, I own the original. It's like like baseball cards or something. I own that card. I don't just own a print. You could photocopy a baseball card, but I own the baseball card. It's just so hard for my head to wrap around the idea that people are interested in owning the original of a digital art where it's a digital work of art where it's just like, well, you can get literally the exact same piece of art off of Google Images, maybe on just like a slightly less definition.
Yeah, it's very hard for me to wrap my head around the art part of it. I was trying to think of, and we were talking about before, maybe some other applications of this, and we were discussing whether you could possibly use code as an NFT, or have code as an NFT. And if that was the case, then there could be a significant use case for having this decentralized ledger where you can see intellectual property, who owns certain pieces of code or software. And that, I think, could be very, very valuable to have basically a decentralized ledger, really. Just basically a thing where you can check who owns what intellectual property. And there's no dispute to be had over that.
Logically, I think that's the way it's going to go, because you think about what's valuable that's digital. And at the moment, we're looking at these NFTs and we're talking about people stitching artworks together. But I mean, like, when it comes to digital assets, what's really valuable when it comes to digital, and it's pieces of code. Code is what's really valuable. Data. That's what, the world is running off of. Code, data collection, that sort of thing. So who knows where this leads? But it's like a lot of people are saying that it's crazy, and I kind of side with them. Is that spending $69.3 million on a piece of digital art when you can just go get it off Google Images seems crazy. But I think once you understand the idea of what it's trying to do and what it could potentially be applied for, maybe it makes a little bit more sense. But in the early days, when we're looking at this and someone's just bought a digital piece of art for $69 million, it's like, what the hell? This is stupid.
And I mean, certainly if you take it from an investment standpoint, which is where a lot of this demand is coming from, people buying these little digital artworks or images and then trying to flip them as they go from being $10,000, $30,000, $50,000, $100,000. That's where it's the end of the line for me. It's not a space where I think you could...
It's speculation, isn't it?
It's pure speculation. And I mean, like every speculative bubble, there'll be periods where people are jumping in and the prices of these digital assets are just flying up.
Well, anything, sorry to butt in, anything non-cash producing... non-cash producing is speculative, right? Because you can't predict what it's going to be. You're just trying to... What's the saying? Give it, hope that some fool pays more than what you bought it for in the future.
Yeah, unless it has some underlying utility, like it's a commodity that is has a use case.
That's of course.
Then in that way I can see it. But then if you're talking about art or cryptocurrency or gold, which has a use case, but it's very small relative to what gold is typically used for, which is a store of value, then you're just hoping someone pays more for it. And there's no way you can actually know whether someone will pay more for it. That's true. And that's scary. That's where it's the end of the line. And to be fair, that's the case for me when I'm investing, when I'm looking at most cash producing assets. Like for most cash producing assets, they produce cash, but I don't know reasonably what I'm going to get back from them. So I put that almost in the same camp as assets that don't produce cash, because if I can't predict what I'm going to get out of those businesses, then I can't figure out what to pay for it. And it's the same, it's the same end, even though some businesses produce cash flow and these digital assets don't. But
that makes sense. This actually leads us into a second bit of news story. So we spoke about that first bit of news on this NFTs, about the extreme, price of that collage. But another interesting thing that is now popping up, because it seems to be in some speculative bubble where, you could, we should turn this McDonald's cup into an NFT. We'll take a picture of it and someone will pay us $1 million for it. Artists are now starting, originally it was designed, artists were getting on board because like, oh my gosh, we can actually earn some money from making artwork now. This is fantastic. Which is, always the problem with art.
We've waited 2,000 years for this.
We've waited literally forever for this. Artists can now make money. Are you serious? But now a thing that's popping up is that people are stealing art to turn real people's art, digital art, into NFTs. So it's like NFT scam.
Oh, wow.
So if you like did a little Photoshop over there, I'd like hack your computer, take your little artwork off you and say it's mine, and then sell it for however much I can get. So that's an interesting thing that's popping up.
Wow. That's
Already there is theft in the system.
Yeah, it's so strange. I mean, it goes so deep. I've done some research on NFTs and cryptocurrencies, and I just always feel like I don't know like 1% of what there is to know.
Yeah.
And I always use the analogy of to crypto or to AI or to these NFTs now to like the internet in the early 90s. Like no one even knew what it was going to become.
Yeah.
People kind of had a vague idea, okay, so I can do instant communication across the world, but you had no idea that there would be something like the movies moving online.
Yeah, Netflix,
so you have thousands of movies accessible immediately, or anything along those lines. So
it's always the way it starts out, and people are like, yeah, I don't know about that, and then people look at this use case, and then they don't think big enough of, okay, what can the underlying technology do for people? What can it become? That sort of thing.
Yeah.
So I mean, I would not pay $69 million for a piece of artwork, but I'm not going to throw shade at people that do, because you never know. Maybe they're the geniuses that think that, that understand that NFTs are the next big thing on the blockchain. So who knows? Yeah. Who knows?
Yeah.
What should we talk about next?
We should talk a little bit about what happened with the Fed this week. So we've got a little bit of Fed news, and then we can kind of relate that to what happened to the US markets last night as well. But Jerome Powell, the chair of the Federal Reserve, he released another video statement. So he did a little YouTube video.
Did he?
No, it wasn't on YouTube.
Oh, okay. I was gonna say.
It was kind of like a YouTube.
Hey guys, it's Jerome here.
Yeah, out on my daily vlog. Interest rates are still zero.
That'd be hilarious.
No, so he basically was announcing that they're continuing to hold interest rates at the range of 0 to 0.25%. And he kind of gave some, their opinion on what they think is happening in terms of inflation and jobs and that sort of thing, and what they're planning on doing in the future, which is now really what the Fed does. They just kind of publicly tell people what they're going to do, and that seems to influence the market more than what they actually do.
Yeah.
Which is an interesting thing.
It's bizarre.
They kind of figured out that people don't really care what the Fed does. They do, but they care more about what the Fed says.
What they say they're going to do.
Exactly.
Yeah.
Because everyone's working on these expectations, which is kind of a funny thing.
It's bizarre, because you're exactly right. It was like when they came out and said, we're going to keep interest rates low for like the next 3 years to help this coronavirus recovery. Then the markets were just like, oh, yes. And just like, there was no confirmation. This was like a press conference or something. He literally just said that off the cuff or whatever. And then markets just went, all right, we'll take that.
Yeah, take it and run.
Yeah, exactly. Yeah. So it's pretty insane.
Yeah, so in this video, he basically said a couple of things. One thing he said was that we should expect short-term inflation. And the reason why is now that we're moving into March, April, and May, we're going to start to see comparisons for the year-over-year inflation from the early onset of the pandemic. And basically on the early onset of the pandemic, there was a significant amount of deflation, as there was quite a drop-off in consumer spending in quite a few areas, particularly in travel and services. I think he mentioned that product inflation there was still product inflation, but the deflation was significant in services, which kind of makes sense because a lot of services require you to gather around other people, which is kind of where a lot of the restrictions were happening. But because there was deflation in the early onset of the pandemic last year, we're now going to be seeing a comparison year over year of that, which we've seen for the first time starting March and then April and then May. So we should expect to see some inflation. I think it was 2.4%. I think he said would be what is expected. Yeah. So
because it's calculated off of the last 12 months added together.
Yes. Right? And then he went on to basically say that There were also supply chain issues that may produce inflation. So we've seen this. I haven't seen this. I haven't looked into this too much, but you can. There's just a lot of industries that are suffering from shortages. I mean, one example that I just think of right now is the fact that they couldn't even produce enough PlayStation 5s. Right? Sony couldn't get their production out, and that's the case with a lot of businesses at the moment. And a lot of that gets passed on to consumers when there's supply chain problems and prices increase for businesses. They pass that on. Again, he thinks these are going to be short-term problems.
Okay.
And as a result, he doesn't expect that there will be consistent high inflation, although we should expect it over the next year. So,
as in a rise in the inflation rate,
in the inflation rate beyond, I guess, what is reasonable. So their target at the moment is 2%, and I think that's the RBA in Australia's target as well. Everyone's kind of the big nations have kind of agreed
it's
that
like 2 to 3%.
2 to 3% is prime for economic growth.
Yep.
But they expect to get into that range, but they don't expect to exceed it massively.
Right. Okay.
Yeah.
Very interesting. I don't know if I can add too much to that because I'm a bit of a dum-dum when it comes to all this sort of stuff. But it is interesting. What you say is that you might see an increase in the numbers, but you should really... This is what we were talking about, I think, last week. You should actually break down why that's the case. I remember we were talking about the Australian inflation rate, how we had that period of deflation. But when you actually broke it down and had a look, okay, why are we in deflation? I was like, because the government's subsidizing this, so that eliminates that little bit. And the petrol prices fell out of the sky, so that caused deflation over there, and no one's traveling, so it was like three things which went bang bang bang. It was like, now we're in deflation. So I think it's just a message of this is what we might expect because it's the last 12 months, because we're ticking that range forward, is we'll see if we had deflation all the way back here, we're going to see that rise in the inflation rate from here. So we just have to try and break it down, I guess, and understand why that is. But I think you've explained that really well. Yeah,
and I mean, it does make sense why you could argue that we could see just short-term inflation. It makes a lot of sense that a lot of businesses are going from very low production, not all businesses, but a lot of them are going from very low production last year to now having to ramp back up, and that takes time. And as they have a limitation on their production, prices will go up so that they can meet that gap. But then as their production gets back to normal levels, say like over the next year or so is what the Fed suggests,
right?
That's when price competition will come back in and prices will actually come back down. But all of this is said with no one really knows what's going to happen. I don't listen to this and go, okay, let's put this in my models. Like it seems like half the fund or most of the fund managers do. They listen to this and they go, okay, let's put that into the model. Okay, 2.4% inflation this year. Let's see how that affects our modeling.
To be honest, I would not like to be an investor that focuses on those things at all. Yeah. Like, I'm so glad that with our investing, it's just like, okay, sure, the market could be doing this, just bouncing wherever. Inflation could be here or there, and, they could be printing money or whatever. There's a lot of things that could be happening. But at the end of the day, as, just two guys that are trying to make some money and invest in some good businesses, it's always just like, okay, well, that stuff doesn't matter. It's more about, it matters slightly because this stuff has an impact on the businesses we end up looking at, but it's really more fundamentally about how is the underlying business performing? Is it still, are the growth rates looking good? Is the expected cash flows over the next 10 years still looking promising? And, in a lot of ways, people that get caught up in the macro, they might go, oh my gosh, shit's hitting the fan. And I go, okay, I'm staying out. Whereas for us, we're looking at these individual businesses, these cash producing machines. And if something happened in the macro, which we see as short term, and that causes the share price of the company that still looks fantastic to plummet, then we're like, oh, okay, short term event, they're going to recover. Underlying business is great. It's a market-wide event or it's a macro event, but we still like the business. Then it's like, oh, you beauty. Yeah. This is actually what we're looking for. I did a video about Monish Pabrai the other day, and he said something like, what you're really looking for is you're looking for great businesses, and then on top of that, you're looking for some sort of market-wide event or some sort of industry event or some sort of company-specific event that's short-term to absolutely beat the share price to a pulp. Like, that's what you're looking for. You're looking for a great company first and foremost, and then just sit on that company and wait until something comes along and whacks it in the face.
Yeah.
And then that's when you buy. It's so simple. It makes sense.
Yeah. Going through our approach or Warren Buffett's principles, you kind of want volatility in a way.
Absolutely.
You want stocks to move a lot so that there's a lot of inefficiency in the market. The reason why you would care deeply about macro is if you're short-term investing, because if you're investing over, say, like if you need to get money in and out over the next 3 years, like you can't invest in a stock that will be down in 3 years, then what the macroeconomic environment looks like matters significantly. Whereas if you've got a 10-year horizon, or in the best case, we're looking for businesses that we can just hold for our life, then that business is going to be going through many different types of economic conditions. And if you're investing long-term, you have more time, if it's a really good business, for the management to adapt to that new situation. For example, if you had like a retail business that had a lot of entry-level employees and there is a minimum wage increase, then immediately in the next couple of years, that's going to have a significant impact on their profitability. Long-term, it doesn't matter. They can adapt their operations. They can become more efficient over time. But if you're looking to make money on that stock, if that stock needs to be higher, more profitable in the next 12 months, then who gets elected matters. What policies they put in place matters. These macro things matter. And another reason why you would care about macro stuff like Ray Dalio does is he's trying to build a portfolio for the uber wealthy who don't want volatility. They don't want to see their portfolio drop 50%. They would rather sacrifice, and this is kind of Ray Dalio's all-weather portfolio, they'd rather sacrifice that extra 1 or 2% return so that their portfolio doesn't go down very much.
Consistency.
When so there's consistency. So each kind of, they have broad diversification. So they kind of capture where the money flows. If it flows out of the stock market into bonds or out of the stock market into gold, he kind of gets a little bit of a balance of that. So
no, I agree with what you're saying. Absolutely. Volatility, a lot of people would look at volatility and go, oh, the stock market, I don't want that to be volatile. I want that to just slowly go up over time. But you're right. If you can understand a business properly and you can feel confident in predicting the intrinsic value of it, then I'd like extreme volatility. You know, I would love it if, we're looking at like a company like Facebook and the shares drop 50% and then go up by 300% and then drop another 80% or something like that. It's like, I would love that. That would be fantastic, because if it's going like this and we know where its value is, when it goes like that, we can go, yes, please. And when it goes up to the sky, we can go, all right, thank you very much. We'll take our profits. And then we can just keep doing that. And I think that's what Phil Town says a little bit as well, is that when it comes to the stock market or looking at individual businesses, you want volatility, because the more it goes down, up, down, up, down, up, down, up, is the more chances you get to buy and the more chances you get to sell as well. So it's just like, okay, I'll repeat this process.
It really does come down to temperament, because
absolutely,
and everyone kind of lives within a certain range of temperament as well. Because I know personally, maybe if a stock I own that I'm very confident in goes down 50 or 60%, I'm very happy to buy it. I know that if it went down 95%, I don't know if I would be confident to get back in. You know what I mean? Like there's a limit to where you're like,
it'll make you crap yourself a little bit.
But for other people, it's 10%. They 10% and they crap themselves and they sell out of all their stocks. So I feel like people live within a different range, and you've got to try and be in a sweet spot where you do a lot of research, so you're very confident. You're not just buying a business as it's going down regardless. But you need to have that temperament to know that if you've done the research, markets can be inefficient. They can get it wrong.
Yeah, I think in all honesty, you touch on a good point. I think the most important thing in stock market investing is to have the right temperament.
Yeah.
I think you can be, dumb as anything, okay? And you can still do extremely well in the stock market if you have the right temperament. And I think that's like one of Warren Buffett's. He says it a bit more eloquently than how I just put it. He's something like, a fool with a plan can beat, a genius without a plan, or something like that. It's all about like understanding your plan, having that temperament, and just only act, not acting on a whim, and actually acting, rationally.
Yeah, exactly right.
But yeah, do we have anything else to talk about with the Fed?
No, that was just about it with the Fed. The only other thing I wanted to touch on was what the stock market did last night, which again, it's not a huge thing.
How much money did I just lose overnight? a lot.
How much money do you have in Tesla?
Oh gosh. The funny thing is with stocks, and this is not definitely the first time I've ever experienced it, the stocks that go up on you like 10x, it's like you don't put that much in. And then obviously if something goes up 10x, it's like, wow, this is a substantial amount of my portfolio now. So people are always like, oh, how much money do you have in Tesla? I'll say, this amount, but that's not how much money I put into Tesla. And they're like, oh, you rich genius, you rich kid, you putting this amount into Tesla? It's like, well, no, actually I put a tenth of that into Tesla.
Yeah.
That's just the way the stock market goes. Very lucky that speculative stocks sometimes turn out.
That is crazy. Yeah.
But what happened? What happened with the good old NASDAQ?
Yeah. So, that fed kind of Jerome Powell's little YouTube video. I don't know what I'm calling it. A YouTube video. I just like the idea
run
that
with it. His TikTok.
He's got a channel with like 12 subscribers or something.
No,
like,
Jerome Powell was like, he's on TikTok and he was like, hey, guess what? I lowered the rate. Just something crazy like that. You just can't get that out of your head now.
Oh, dear.
That was a little YouTube only moment. If you're listening on Spotify, you're going to have to go watch that one.
Head over. You're missing out. No.
You're missing out. All right. Focus.
What were we talking about? Yeah,
Back on track.
So that Fed news thing came out a few days ago, and the market roared after that. It went up a ton. It was crazy. I think my portfolio was up massive that
Cha-ching.
day. It was good in some ways, but obviously we want to see stocks come down.
Yeah.
But then last night there was a big sell-off. So
okay.
It was mostly in tech, and the reason why was the US 10-year Treasury yield continued to rise. It's been going up quite consistently for a while now. It's now at 1.7%, which is kind of crazy to say.
Yeah.
Like, it's been going up.
And now it's at 1.7%.
Yeah, it's ridiculous. Like, talk to me when it's at 8%.
Yeah.
And people are panicking.
Yeah, exactly.
But so whenever US yields go up, typically that hurts growth stocks more. And the reason why is quite interesting. So first of all, the 10-year US Treasury yield is used as the risk-free component in valuation. So a key part of valuation is to compare what you're investing in, the cash flows of the business or the profits of the business, to what you could achieve if you had just invested in a risk-free investment, which theoretically doesn't exist, but the closest thing to something that is risk-free.
Unless the United States of America
defaults.
Defaults.
Which is arguably impossible because they can print money.
Yeah.
So
because they control their currency.
Yes.
Yeah.
So
things could get bad, but they couldn't go flop on their belly, right?
No. They could print money and the inflation could outpace the return you get.
Yeah.
So the real return is terrible or negative.
Yeah.
But they can't really default on it. So we call that the risk-free alternative to investment. And that's kind of part in valuation. And how valuation works, of course, is you're projecting future cash flows and then discounting them. So for businesses that have significant future cash flows compared to their present cash flows, i.e. growth companies where most of the cash the business you're going to get back from the business is far into the future, for those businesses, they're much more sensitive to changes in that discount rate, which a major part of that is the US Treasury yield for a lot of funds. So that happened overnight. There was a slight increase, and it basically it did significant damage to a lot of tech businesses. I just wrote down a couple here of the big ones that I saw.
How much has my poor old Tesla been hit?
Tesla's been hit by negative or down 7%.
Ouch.
So that's a big drop.
Ooh.
Amazon was down 3.5%. Apple was down 3.4%, which Apple's an interesting one to be in there. I know it is a tech company, but I guess people do have big growth expectations for Apple still, right?
Still. What is it? Which is the second largest company in the world at the moment?
Yeah.
Third or something? Yeah.
Yeah.
It's insane.
And they've got a pretty significant valuation, I think. Maybe 40 times current earnings or 35 times current earnings or something. So, yeah, they all fit into that category. And of course, any business that doesn't produce any cash now, meaning all of the cash you're expecting to get out of that business is 3 years down the road or
somewhere
5 years down the road, they're going to be very, very sensitive to these changes.
Right. Okay.
And it kind of makes you think, right? The yields went from, I think it was 1.6% to 1.7%, and Tesla comes down 7%.
Uh-oh. You're making me want to sell my stocks here.
No. I'm not telling you to do anything. You enjoy the ride.
I'll enjoy the ride up and I'll enjoy the ride down.
Yeah, but it does kind of make you think. Like, if there's no inflation, everything's going to be fine. But if there's inflation, and typically what happens is if there's inflation and people hold treasuries, they sell those treasuries to get a greater yield on them, because why would you hold a 1% treasury? Why would you hold a 1.7% treasury if inflation's 3%? You're losing 1.5. You may as well take it out, which means you're going to sell it, and then those yields will go even higher. And you'll look for an alternative investment, and that will further increase the yield and put even more downward pressure on stocks. So that's kind of the concerns is kind of what we saw last night, is if people think inflation is going to be higher in the future, even in the short term, it's going to cause those yields to go up and stocks to come down. So,
okay.
Yeah.
My gosh, you are very smart on these sort of... this is where I start to fall apart on this sort of stuff. This is just so bonds and treasury yields. I'm just like...
Yeah, and look, to be honest, like this is all just like corporate finance, university stuff.
Yeah,
but at the end of the day, as I said with the inflation stuff, nobody knows what's going to happen. Like, it's not like I read this and maybe I understand what influences stock prices, but I have no idea what the yield is going to do. So there's nothing I can kind of work with there. Someone like Ray Dalio will argue he knows how, his research knows where the yield is going to go, but that's not something I'm very confident in being able to do. So we'll see what happens. But
yeah.
So
there you go.
Yeah.
Very interesting. So some stocks getting hammered. My poor old Tesla tech stocks coming off. Oh my gosh, the US Treasury yield has risen. Oh.
The funniest thing that happens when there's a day like this, especially after, the last 2 weeks have just been straight up. A day like this will happen and there's a ton of videos out. Buy the dip. Buy the dip.
I was going to say the same thing. It's time to start seeing those thumbnails on YouTube where it's like, what am I doing in the stock market crash?
Tesla down 10%. Are you buying the dip?
Yeah, buy the dip. Yeah, exactly.
Even though you could have bought it for cheaper 2 weeks ago.
Yeah.
Are you buying the dip?
Yeah. It's just like, what can I put in this thumbnail to make you click on it? I don't care if it's BS.
Yeah. I made a video on that once, how a lot of people's strategy is buy on red days. And I made a video just saying that just makes 0 sense.
No.
It's completely irrational.
Yeah, it doesn't matter.
You could be buying on a green day where the stock is undervalued, or buying on a red day where the stock is overvalued. Yeah. So which one's better? You want to buy on a red day after the stock's gone up 100%, or do you want to value it, figure out what it's worth, and then buy it before it goes up 100%?
Yeah.
I'm in the first camp there. But
Yeah, that sort of thinking is stupid, because if you looked at like the S&P 500 and you wanted to buy on a red day, and let's say you even just smoothed out the line of the S&P 500, it would be buy. Oh no, sorry, it would be the opposite. It would be don't buy for forever, and then there'd be one day where it'd go down a little bit, and then you'd be like, okay, buy.
And then that's buy. Yeah.
Yeah, and it turns out if you bought it like 2 months ago on that green day, you would have done so much better.
Yeah.
Good old Green Day, what a band. Guess how long we've been talking for?
How long have we been talking
45 minutes.
Wow.
Yeah.
Oh my God. This is going to be a long one.
It is going to be a long one. Do you want to get into some questions?
Yeah, we should.
For not very much to talk about, we have really stretched this out.
We need to do this more often. I need to come to Canberra.
It's so easy just to talk for longer when we're talking in person. All right, what should we talk about? Let's pick out. So we got a lot of Q&A questions.
Yes.
So let's just rattle through a few of them.
Yeah. Okay.
Do you wanna pick one?
Yeah, I'll start with this one from James. It's at the top.
Okay.
Fourth from the top. Hi guys, great work on the podcast. Thank you very much. Appreciate you tuning in. Makes the long drive go a little bit quicker. Keep up the good work. Oh, well, that's good to hear. Bit of a lighter question. At what stage will you guys be too old to be called the Young Investors Podcast? Really serious question here. We're going to get to the bottom of this.
Well, for me, it's probably pretty soon. You got a few more years. How old are you?
I'm 23. Oh, I will be 23.
You will be 23. Yeah. When do you turn 23?
June.
Okay. Yeah. And I just turned 26. Yeah, 26.
Right. Yeah.
So we can probably run with the Young Investors Podcast until we're 30, surely. If you're in your 20s, you're young. When does middle age start? That's not. There's like, what is your 30s? I'm gonna look this up because I have no idea.
Middle age. I would guess 45.
Middle age is the period of age beyond young adulthood, but before the onset of old age.
Really?
Wow.
All right, next question.
Most sources place middle adulthood between the ages of 45 to 65. Okay, so we're still young until we're 45.
Okay, so when you turn 45 and I'm whatever, I'll be 42.
42 or something, 43.
Then we'll call it the
middle-aged investors podcast. All right, great. I'm glad we got that one sorted.
I couldn't think of anything worse to listen to than
the middle-aged investors podcast. I don't know. You just picture some like weekend warrior footy bloke, you know, that's like slightly overweight, balding, going, "Did you buy Bitcoin today, mate?" Yeah, you did. Yeah. What about Tesla? Did you buy Tesla? Nah. Oh, that is exactly how I imagined the Middle-Aged Investors podcast going. Anyway, sorry. Let's move on.
What have we got?
Let me ask you one. I'll send this one at you. Good day. Just want to ask how you guys reinvest your capital gains or dividends. How do you go about reinvesting?
That's a good question. In terms of, so I'll break this down into like my index funds and individual stocks, because I do something different with those two. Index funds, they're automatically reinvested. So the index funds are with Vanguard and iShares. I'm not sure about the iShares one actually, but the Vanguard ones do reinvest. So that's just automated. But with individual businesses, I actually take the cash dividends and I just put that as the cash part of my portfolio because I want to be a little bit more selective when it comes to individual businesses. So
right. So you don't want it to just buy at any price.
No, and yeah, that might be controversial, but for me, at least for the bigger positions in my portfolio where I may get substantial dividends from them, they're nowhere near prices where I would be comfortable putting money in. So I take dividends in the same light as that.
Right, okay.
And I take them as cash. But with that said, I don't have a dividend portfolio. So it's not as if I'm getting a 3 or a 4 or 5% yield on my portfolio and just dumping it in cash every year. It's probably 1.5%.
Yeah.
Something like that.
Yeah. No, I think that makes total sense. And to be honest, I don't think any of the individual stocks that I own pay any dividends. So
what have you got?
Mainly tech stuff. Yeah, no, I don't think so. Not. Yeah, probably not. So that's not an issue for me at the moment.
Yeah.
But yeah, you're exactly right. ETFs, you're thinking passive investing, so you just like buy. So it's just like, I'll just keep reinvesting dividends. But you're right. If you had a substantial position in, an Amazon, say Amazon paid a dividend, they don't, but you might look at the price and go, okay, I've got this substantial dividend coming in. I don't want to buy Amazon at $3,000 a share, so I'll just take it in cash, and then I'll keep that cash on the sidelines until I get a chance to invest where I want to invest and then put it in. So that's I don't think that's too controversial. I think that makes sense.
Yeah. And I mean, the other point I think would be important is using that Amazon example, you get the dividend. If it's automatically reinvested, you're just buying more of Amazon. Whereas if you keep it as cash, you can buy more of Amazon at a better price at some point in the future, or you can put that in a different investment. If there is something that comes up, that's
you're not locked into Amazon
at a better deal. And yeah, maybe that would change at maybe if there was an extended period where the stocks in my portfolio were undervalued and I consistently thought that for, I don't know, like it seemed like it was a year or 2 years or something, then maybe I would look into having the dividends auto reinvest. Because then that makes sense because I'm happy for it to go through and I save the brokerage. So
yeah, exactly.
In those cases, yes, but that's just not the case right now.
Yeah. I think that's a good answer. All right. Should we go on to this next one?
This one?
Yeah.
All right.
This one.
Hey guys, great podcast. My question is related to circle of competence. If I am wishing to invest in a new segment of the market that I'm currently not familiar with, how much knowledge of the industry would you deem appropriate before feeling confident enough to invest in it? Interested to hear your thoughts. Cheers.
Yeah, this is a good question. Really good question. Look, there's the whole concept of analysis paralysis, I think is something which is interesting to bring up, where you quite rightly so want to go so in depth and make sure you really understand it, but you go so in depth that you never make a decision to buy it. But having said that, I mean, if it's a new segment of the market that you're not familiar with, I would not invest in that segment for probably a couple of months. I don't know about you. But some people say, this new stock I'm looking into, I've looked into it for about, a couple days, or they say I've looked into it for a week. And maybe they can read 10 times faster than me, who knows? But for me personally, I would not feel comfortable getting into a new business in a new industry I'm not familiar with until I've really read up on that business and also the other main players in that industry. And for me, like being real and actually following the news cycle of that industry, that would take me a couple of months.
Yeah.
Like, truth be told, that wouldn't be a fast process.
Yeah.
That being said, you might, and I think it's important never to rush in the market. And even if you, I mean, you might say, well, Brandon, what if, you know, this great stock that you think is in a great industry, but you haven't studied up too much. What if it just, something happens, like bang, explosion, market-wide event, and then it goes down and it's like dropped 50% and there's pressure on you to buy? I still wouldn't buy until I felt like I was across it.
Yeah.
And I would obviously try and do my research a little bit quicker and hurry myself along, but I still think it would take me quite a substantial amount of time to get up to speed. And maybe this is different for everyone. I mean, you've studied this stuff at university. I'm literally like just a dude that has read some books. That's me. And I'm not afraid to say it, you know. All of this stuff about economics and finance and stock market investing, I've just learnt by reading books from, you know, people like Warren Buffett, Charlie Munger, and Monish Prabhu and Phil Town and that sort of thing. And for me, it does take me a long time because there's still some jargon that I'll come across. I'm like, what the heck is this about? Non-fungible tokens?
Yeah, there's constantly new things that are coming out that you don't understand. Yeah, I'm very slow to get into investments. I think Texas Roadhouse is a good example. I started looking into it at the beginning of 2019. And keep in mind, I worked in the restaurant industry for 3 years, I believe. So I already had a pretty good understanding. I find it fascinating. But at that point, I first looked at that company. I first invested in them 6 months later in June of 2019. And it was a very small investment. Like, it was a dip my toes in investment.
Right.
I didn't significantly invest into that company until March of 2020, which is probably about 14 or 15 months after I first discovered that stock or first came across that business. So that's a typical timeline for
I remember how excited you were about making that investment too.
I was very excited.
You were so pumped.
It's done very well.
So pumped. It has, hasn't it? Well, what sort of return, what sort of percentage return would you be sitting on?
I'll have a look. It's
like what, 100%?
It's insane. It's
more than that?
I think an 80% compounded return.
Oh, okay. Well, that's impressive.
So yeah.
That's impressive. But yeah, long story short, to answer the question, definitely you need to really understand how that industry works. I think you need to understand what the growth of the industry looks like. And I would typically do that by looking at the main players in that industry and what they're doing and how they've grown. And then you start looking at that individual business that you think might be good, and then you compare it to the big players and you read in depth and think about, you know, what's their roadmap? How are they growing? Do I believe they can do it? Are they in a good financial position to make it happen? And then from there you kind of go. But that process is not quick for me anyway. For me.
Yeah, and I think just one other point on that. Over the course of that year, the main question that I'm asking myself and trying to find as much detail in is what is important for the growth of this business and for keeping it competitive. Like, what are the main factors in that industry? And they'll be different for every single industry. For the restaurant industry, it's comparable sales driven by traffic. You want to see as much traffic as possible because that's your best indicator that people love the food there and that they're coming back. They love the service.
They'll keep
everything else is secondary. Restaurant businesses can grow by just expanding. And they can do that on debt, and it can be a terrible business and their numbers are all growing because they're just expanding, and then they stop expanding because they run out of money and oh crap, no one's coming through the doors. Less people are coming through than last year.
Oops.
And all of a sudden the business is garbage. And they can't pay their leases and then they go.
That makes sense.
You
focus on the competitive advantage.
Figure out what is driving that business, and that can take a while to figure out. And just take your time with it. There's no rush. If you find the industry interesting, you're going to stumble across what it is eventually. Just through being curious. So just take your time. Read as much as possible.
Yeah, absolutely. Did I ask that one to you? Or did you?
Yes, you did.
You want to do this one about stockpiling?
Yes. If I stockpile into a business for 6 months, for example, and then want to sell out after 12 months, do all of the shares bought qualify for being owned for 12 months for tax purposes? Or does each batch of shares start the 12 months when bought? Cheers.
We got to be careful not to talk about tax too much because we definitely can't provide taxation advice. And I'm not a tax professional, so I'm not 100% sure on the question, but I remember when I was talking to my accountant about this and when I was making the tax content for Profitful, if you're stockpiling into a business over time, this is in Australia too, by the way, so I'm not sure if this listener's in Australia or international. But you've got two methods of tracking your shares in Australia. You've got either first in, first out, which is basically always the way it goes. So you've got to track, when you bought and, if you stockpile over 6 months, you got to follow that buy, then that buy, then that buy, then that buy, then that buy. And then as you leave, you sell the first sell you make, is the first buy you make kind of thing. So it's first in, first out. And then if you don't track it that way, then it's parcels. So if you have, say, Commonwealth Bank and you've owned a parcel if you have a big long-term investment in Commonwealth Bank and you've held it for 10 years, and then you buy Commonwealth Bank just a little bit and then you sell the exact same amount like 3 months later, then you can claim that I bought that little parcel and I'm selling that little parcel and I wanted to leave my long-term investment alone. But you have to have good evidence to show that.
Right.
But I believe to specifically get to this question, I believe that no, not all of the shares would be lumped together, even if you stockpiled in over 6 months. You would have, for the 12-month tax purpose, it would be, that parcel, has it hit 12 months?
Yeah.
Then the next parcel, has it hit 12 months yet? And so I think you'd have to track it like that. However, I would put a big asterisk next to my answer and say, please check with your tax professional.
Yeah, I probably shouldn't add anything to that. I think that's as good of an answer. Yeah.
So definitely don't take what I just said as gospel. Definitely reach out and talk to your accountant, tax professional, so on and so forth. All right, let's talk. Should we do another one? Have you got a good one? How about this one? How do you come up with an accurate growth rate of a business for the next 10 years to be able to calculate its intrinsic value?
Yeah.
Wowee.
Yeah, that's a question that...
dense.
Yeah, a lot of people want a nice, simple answer to this question, but there's no easy answer.
It's just
to
this
question.
Plus this divided by that.
Yeah.
Done.
Yeah, you just take the price, and then if it goes down 2% that day, you buy. You buy.
Oh dear.
No, but there's no easy answer. But this kind of relates to our other question where we were talking about trying to identify the key drivers that's pushing the business forward and making sure you understand a lot about those. I call those key business indicators. I think they're technically called key perforance indicators.
KPIs,
I think is the...
KBIs.
KBIs, yeah. Trademarked.
Yeah. Make an NFT out of that or something.
Exactly right. No, so I try and identify those, and if you do understand the industry very, very well, then you would know what those indicators are, and those indicators are what you're projecting forward. So I guess we could just continue with the restaurant example, and I really like using restaurants or retail to explain this because that's how I understood it well the first time. Just a really simple business where there's not too many moving parts.
Right.
Before you go and try and calculate the future cash flows of something like Amazon, where there's like cloud and this and that, and it's like, what are the key business indicators? But for something like a restaurant business, it's going to be a couple of major things. One is what I said before, which is comparable store sales. So the sales in their existing restaurants, you can come up with a projection of what's reasonable for growth in that. If they have a 2% increase in traffic every year and a 1% increase in prices to go along with inflation or whatever, you can project that. You can also project the number of restaurants they'll be able to open based on how much capital it requires them to build those restaurants, how much cash flows they have, what debt they'll need, and then also just the geographical landscape of where they're building. So if they're in the United States, they've got a lot of space to grow, but or if they're going international, they've got tons of space to grow. You've got something like a Starbucks, which has 33,000 stores globally. McDonald's is up there as well, 20,000+.
Yeah. But if you're trying to start a big grocery chain here in Australia, there is the limit to the market size. Yeah.
Exactly right. Like grocery stores is one where they really don't build new grocery stores anymore. It's kind of, you've got to understand the industry and where the density is on that, and what room there is there. And then there'll be something like restaurant margins or retail margins, and then cash flow margins and that sort of thing. But I'm simply just projecting those things, and I'm being very, very safe in my projections. So even if I think they can build 300 new retail locations over the next 10 years, I might project 200 or something like that. And the other thing I do is I always project a range. So I won't just pick 300 new retail locations in the next 10 years. It'll be 100 to 300, somewhere in that range. And that will give me a range of future cash flows and therefore a range of intrinsic value. So that's how you go about it. It's a lot easier. It's still not easy, even with something like a restaurant business, to project margins. Even like Texas Roadhouse, they really only have one, in terms of food cost, their biggest cost is beef, of course. But other food businesses will have a wide variety of commodities that are influencing their costs. And, then you even in a restaurant or a retail business, which is relatively simple on the scale of things, it can be very, very challenging. So, it takes a long time.
Right.
Hence the 15-month wait. Even on a restaurant business, something like Amazon is very difficult to value. And most businesses I find impossible to value, honestly. I look at their business.
And there's nothing wrong with that.
No, there's nothing wrong with that, because there's restaurant businesses. I don't need to invest in cloud computing or something like that, where it's very much up in the air what their valuation is. So yeah. That's
a very Warren Buffett answer. Yeah. If it's, you're right. If it's not up your alley or it's too hard, then just put it in the too hard pile.
The only thing I just realized, I was looking at my notes, have a margin of safety on top of all of that. Even after being safe, even after being conservative and doing a range, you're still probably wrong. Yeah. still think you.
It's true.
It is true.
I think one of the biggest killers in stock market investing is people thinking they're right.
Yeah.
And I'm right. Of course I'm right. I read this article. I'm right. I think the people that do well in stock market investing are the people that go, I'm probably wrong. So I need to do this and that to account for the fact that I'm probably wrong.
Yeah.
If you do that, then you do very well. If you go through stock market investing and think, nah, that's not going to happen because I know I'm right, you're going to cop it.
Yeah.
Might not be, you might be right once or twice, but eventually you're going to get complacent and it'll get to a point where you're going to cop a smack in the face.
Yeah, exactly. There are so many businesses where if you buy them today, everything needs to go right. Everything needs to go
Absolutely.
right. And I'll do a valuation and it'll be like, oh, okay, stock needs to go down 80%. And people will be like, oh,
Hamish, you're so stupid.
When on earth is that going to happen? Yeah. I said, well, maybe it won't happen, but that's the only place I feel confident on that business. Or maybe for another business, it's dropped 50%.
Yeah.
Because that's the only place where I'm projecting certain numbers where I would be comfortable. If I projected the numbers required to buy the company today, I'm not comfortable. That may happen, but I'd have to be a genius, and the management team would have to be a genius, and they'd go on to grow at a ridiculous rate.
Yeah.
Yeah.
No, good answer, friend. Let's, should we get on to another one?
Yeah, where should we go?
Maybe this one below?
Yeah, okay. Have you guys looked into other asset classes? If inflation rises, how do you know whether it's worthwhile switching some money over to bonds, gold, and even Bitcoin?
Look, to be perfectly honest, I can understand. I can understand why, the rationale behind why people are buying gold and why people are buying Bitcoin and whatnot, especially with all the money printing that's going on. But at the end of the day, when it comes, I got to keep it simple for me because I'm a dum-dum. But when it comes to asset classes, I like one asset class, and that's cash producing assets. This is going back to what we were talking about before. If it's a cash producing asset, if it's a business, if it's a rental property, then I can look at what is the expected cash flow, and then I can get an understanding of, okay, what would a fair price for those cash flows be? And that's the only asset class that I'm interested in. You can say you're an idiot for not investing in gold, or you've missed the train on Bitcoin and how dumb must you look. But at the end of the day, that's the only thing I feel comfortable in buying, is something that produces cash and grows over time, because then I can figure out obviously the growth, and I can predict, if it's got a long track record. You can look out into the future, say, okay, I think it's going to grow at the historical growth rate, work backwards, figure out, okay, I'd be comfortable with paying this. So that we can have some sort of confidence in the return that we're going to get on our money.
Yeah.
So that's a boring answer, and I know that you a question like this is asking, well, what about, all this money printing and cash is getting devalued, and maybe Bitcoin is the answer, or at least have some gold. But at the end of the day, that's just not how I know how to invest, and it's not how I'm interested in investing. So I want cash. I am a money-crazed little shit. Remember that part of the start of Wolf of Wall Street?
Yeah.
He walks in, he's like 20-something years old, money-crazed little shit. Nah, not really. But yeah, does that make sense?
Yeah, I think so. Or? Yeah. I think people think investing is about catching the right wave and not missing an opportunity. Investing is really just don't make stupid mistakes.
It's really it.
And if you avoid stupid mistakes and you find something that you think has value that you've really deeply studied, you only need a couple of those and you'll do quite well. And things like gold, Bitcoin, I mean, it could be a mistake to miss out on them. That's entirely possible, but I just don't know enough about it to dive into it. And I would much rather not go into areas where I feel like there's a good chance I could lose.
Yeah.
So, yeah.
No, that makes sense. Okay, let's have a look. Are there any other questions that we could talk about? Hamish, you finding any? We've covered a lot of these. We've covered a lot of that.
Yeah, let's do this one. This is a nice, fun question.
All right, go.
Okay. Here are some questions away from finance and markets.
Oh, okay.
All right, tell me, Brandon, how is it being Aussie? Do you feel...
Aussie. Oi, oi, oi.
Do you feel to be far from the rest of the world?
Do I feel like I'm far away from the rest of the world? Sometimes I feel like that, but I definitely feel like I'm far away from the rest of the world when we have to, if we want to track what's going on in the US market, we have to wake up at, we have to stay up until 1 a.m. and then try and execute something by, 5 or 6 a.m.
Yeah. All the excitement happens overnight.
It does, doesn't it? So we miss out on that a little bit as it's happening in real time, but it just means you wake up to a whole bunch of news that you can look at. But I don't know. How does it feel being Aussie? It feels pretty awesome because we don't have much coronavirus.
Yeah. The rest of this question is, what do you like of Australia and or Melbourne? Yeah, I think that's probably one thing I'm very, very happy about, being in one of the countries where we handled that situation very, very well.
I mean, it sucked. It sucked having, well, I really can't talk, but for you, being in Melbourne and copping a lockdown, and man, that must have just been demoralizing. But I think that the outcome has been worth it.
Absolutely. Yeah. And even I'll be honest, there was a while during the middle of those lockdown months where I'm like, man, this isn't working. Just let us out. Yeah. But out the other side of it, it is very good that they handled it in that way.
Yeah. No, it's been handled pretty well. This is something, if you're an international viewer, you might find this quite startling, but I went to Sydney, 2-3 weeks ago, and I went on a train in Sydney, and that was the first time that I had to wear a mask under some sort of rules or regulations.
Wait, what?
Because I live in Canberra, so Canberra has had no COVID.
Really?
For there's literally been not a case for 9 or 10 months or something like that.
Wow.
Yeah. And I went to Sydney, and getting on that train was the first time where a law had made me wear a mask. because
crazy.
because it was advised to help contain the spread of coronavirus or something.
That's insane.
It's pretty insane. I mean, that's kind of like, yeah. I mean, if that's, and I was talking to Nate O'Brien not too long ago, and he was like, "Oh, how's COVID over in Australia?" And I said, "Yeah, it's going well, you know." He's like, "Oh, are you getting sick of these masks?" I was like, "I don't have to wear a mask." He was like, "What?" I was like, "Yeah, nobody in my city has coronavirus." And then he was like, "Dude, what?" And he said, like, I'm pretty sure like 5 people on my street have coronavirus. I was like, oh my gosh, man. Oh, I do feel sorry for the countries that have had such, I mean, we got to tell it how it is, such poor, like just political mismanagement of COVID. It's been really startling to see, and I'm not pointing the finger to any one particular country because there's been a whole bunch of them, but it is sad to see politics get in the way of effective management of a highly transmissible virus.
Especially in the early stages. It's very interesting because you have each government doing their own research, and there was, you know, people reach conclusions about whether masks were necessary or not, and then that kind of consolidates over time. Okay, yes, masks actually do help, because there was a long time where there was conflicting information, like genuine information coming out of different governments saying, yes, they're necessary, or yes, they're good at preventing the spread, or they're not. And now it's consensus, right?
Yeah.
But it's interesting seeing that play out, how like you have all of these different opinions, and then it consolidates. And we were fortunately on the right side of that early, whereas other countries they got bad data, bad information, or whatever it was. Or they just didn't want to do it for, as you said, for political reasons, one way or another. So
I reckon out of all of the countries, though, I reckon New Zealand wins. Yeah. I reckon New Zealand has won it in terms of best coronavirus management.
Yeah. Good job, Tom.
Yeah.
Well done.
Jacinda.
Prime Minister investing with Tom.
Yeah. Prime Minister Jacinda Ardern and her top advisor investing with Tom.
Yeah.
But it's so true. I mean, New Zealand, that I saw a couple months back, there was like a massive festival, and there were like thousands and thousands of people like moshing away and just partying. I was like, wait, what about wait, nobody there's got COVID.
No one has it.
Yeah, no one's got it. But anyway, it definitely helps when your country is an island.
That's true.
One thing. When you can build walls, but the wall is just the ocean.
Yeah, there's definitely certain advantages to that.
Yeah, definitely, which we've seen play out. But anyway, talk about the COVID podcast. Welcome back, everybody, to the Young COVID podcast.
Yeah, there's one other part of that question I didn't get to,
me, and then we'll finish up.
And then we'll finish up. Yeah. What would you have done if you were not a YouTuber or a teacher of business analysis, and a personal trainer, Brandon? Are you still doing personal training?
Physiotherapy.
Physiotherapy.
Right. No, I don't do that anymore.
Right. Okay.
It got to a point where YouTube was just like, it was just like dangling the carrot, you know? Yeah. And it's like, you can have this carrot, but you've just got to go all in. I've just got to lunge for that carrot. So I just decided to just, you know what? Let's have a crack. Let's go crazy at YouTube. And I just stopped doing the physio altogether. And I was like, let's just go for it. And far out. In hindsight, best decision. Literally, that is the single best decision I've ever made in my life.
Yeah, me too. And I feel like, maybe not, but I feel like I took a little bit more of a risk because I did it very early.
You did it before I did it.
Yeah, I did it very early. And I was a much smaller. I still am a much smaller channel, but I was a very, very small channel
compared to where you are now. Yeah.
I just thought, like, if this is even 10% of an opportunity that I think it is, I have to just go. I have to go at it. Like, I'll regret it if I wait another 1 or 2 years and I don't get the same output as what I could have done.
Yep.
Over that time. Yeah, I agree. Single best decision. If anyone ever asks this, there's no doubt in my mind that that's what it was.
Well, what do you think you would have done if you didn't, if you weren't making YouTube videos and running your business?
Yeah, I had to think about this question. It probably would go one of two ways. Either I would be in a different business, following some of the interests that I have, some of the passion.
You'd still be running your own
business.
But
into business. Yeah. Either that's probably the most likely path I could imagine. Or just something in traditional finance. So going into asset management or something.
Right.
Something boring like that.
So, yeah, that is boring. That is boring.
Someone tells you how to invest. You need to your clients care about the next quarter. So
Yeah.
better get rid of Thor Industries.
Chop.
It's been down for 18 months now, Hamish. Get it off your books.
He said back, no, believe me, it's gonna go okay.
Trust me, one more year.
Yeah, and I think I just would have continued being a physiotherapist, to be honest.
Yeah.
It was getting a little bit rat racy though, physio.
Yeah.
It was getting a little bit rat racy, like just showing up, working long hours and just doing the same thing. So
Yeah.
I'm glad I made the change. Actually, one thing in hindsight now, I really like business. Business is great.
Yeah. If you had to go back before university, would you do a business degree?
I probably would have done either engineering, I think, or some sort of business degree, I think. But I kind of just like trying to figure it out myself.
Yeah.
I kind of like,
Yeah.
the government's just like, get your ABN and then
Have at it.
go and then
Yeah.
figure it out.
And look, in all honesty, the Bachelor of Commerce, it doesn't... I wouldn't say it guides you into
Doesn't prep
business
you.
in any substantial way. The marketing is just... Maybe I'll hurt a few people's feelings here,
It's
but
alright.
the marketing to me was just a waste of time. Like there was,
Right.
at least from what I did, and I only did very early marketing. I didn't
Right.
go on to advanced, but
Okay.
compared to what I would describe marketing is in what we do, marketing ourselves online, it was completely irrelevant.
Completely
But
different, yeah.
I guess just the practice of doing maths is probably, and accounting was
Yeah.
probably the most valuable thing. But
Yeah.
it is fun, kind of figuring out, going out and just and realizing that you can just make a bunch of decisions and
Yep.
you won't really know how it plays out until a couple of years later or a year later, and you could go,
And I've really enjoyed not knowing as well, because it's made me connect with people that I've really valued. Like I've had to connect with an accountant, and I've had to connect with a lawyer, and I've had to connect with these sort of people to pick their brains and to understand the ins and outs of their own profession and how that factors into running a business. Like, what are the legal aspects of running your own business? What are the taxation implications and that sort of thing? Things that I just had no idea. So it's been really good in that sense of trying to, smash it out and do it all yourself, is that sometimes you hit a roadblock and that forces you to reach out to these professionals that can teach you so much.
Yeah.
And like, even just working with Scott, my accountant, it's like, I know so much about tax now, and I was a complete dum-dum before. Like, I knew nothing at all about tax until I met him. And it's been a really good learning experience. So that kind of leads into one more point that I wanted to make. You don't have to take the traditional approach to get there,
Absolutely.
If you want to start a business, you don't have to do a business degree.
I would even argue, if you know you want to start a business before you go to university, I would take a gap year and I would try and do that.
Try and do it.
Yeah.
Yeah.
Because
don't faff about. Time is money kind of thing.
I mean, particularly if you want to be an entrepreneur, you want to start your own business, the commerce degree is not going to really give you much. I think it's much more valuable if you want to go into a traditional finance job or traditional marketing and work for somebody else. The only part, as I've always said, is accounting. I think was really valuable for what we do specifically. But I would just go for it. I would just have at it for a year. And if you really commit yourself for a year, you can see whether you'll get some traction. You can kind of figure it out after a year. Yeah. In a lot of cases, and then if it doesn't work, you just go to uni.
Sounds good.
Just uni.
Just go to uni for 4 years.
Just
5 years, whatever it is.
Yeah.
No, I agree. I think more people should start their own business, but maybe a topic for another day.
Yes.
Well, thanks, guys. Thanks very much for tuning in today. This has been fun. It's just so much better, man. We always say this when we do live podcasts. If only we could do this every week. It would be so good. It would be so good, but we'll have to figure that out for the future somehow.
Yeah.
This is a nice little podcast recording studio too. So hopefully the audio sounds crispy fresh. That's partly down to these microphones, partly down to Hamish, who now has to go and edit this whole thing together before it gets into your ears tomorrow morning.
So excited.
Cop that. Whereas me, I'm going to the footy.
Yeah. Enjoy.
I tell you, I'm down here with a couple of friends. We want to catch some footy games. We went in because all the tickets were released really late. So they were released like 2 days ago, today being Friday. And we thought, 50% capacity max, that's 50,000 people at the G, that's 27,000 people at Marvel. So we're thinking, if we get tickets to 2 out of the 5 games here in Melbourne, then we're going to be doing all right. We scored tickets to all 5. All 5, and we don't have any sort of fancy memberships or anything. We're not MCC members or anything like that, not AFL members. We just could not believe it. So this trip, we've definitely got the rub of the green. We've definitely got the luck with us on this trip. So
that's fantastic.
Everything has just been working out. Touch wood, but so far this has just been like smooth sailing.
Yeah, no, that's great. Footy weekend.
yeah, exactly right. So I'm very excited. I mean, not business weekend.
Sorry.
I'm here strictly on business.
Sorry.
Anyway, we're going to wrap it up and get out of here, guys. Thanks very much for listening. As we always say, we do appreciate your time and listening to our ramblings.
Yes,
and we hope that the live podcast, give us some feedback. Do you like these live podcasts? Do you think they flow better? We certainly think so.
Yeah.
Do you prefer it when it's much more kind of bang, 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 kind of informative of the normal podcast? But let us know. Head over to the YouTube version. Well, if you're listening on Spotify or Google Podcasts or wherever you find podcasts, just give it a try. Go over to the Young Investors Podcast YouTube channel. Make sure you click subscribe, but also check out this video version of the podcast, and we'd super appreciate it. But let's get out of here.
That's it.
All right. Thanks very much, guys. Thank you very much for listening. Well done, Hamish, on another live podcast, and we'll see you guys. Well, you'll hear us next week. You won't see us next week, but you'll hear us next week. Goodbye.
See you guys.